For most Americans, the only investment they will ever make in their lives beyond their personal residence is investing in the stock market. It seems today like this is just basic personal finance 101, that if you want to invest, the best way to do that is to just buy the US stock market. Despite the fact that this seems like investing 101 and basic knowledge today, actually, this wasn't the consensus for a very long time. For many decades, the primary tool for investors was bonds. And the main tool that people use today to invest in stocks is their 401k through their employer, but that wasn't even created by Congress until the 70s. So the question is, despite the fact that it seems like common knowledge that the best place for any investor to start investing is the stock market, is it actually a good investment? And what returns might you expect going forward if the past is any indication of future performance? Which we know it's not. Well, I'd like to show you a few charts from this website, The Measure of a Plan, that talk about what returns this US stock market has gotten by years and by decades. You'll notice over here on the right, there are two lines. One of them is the arithmetic mean and one of them is the geometric mean. This is a very, very, very important, it's a vital distinction here that almost nobody knows about. Very important. We're going to come back to this in a minute. Shout out to Sam Parr at the Sam Parr on Twitter. This is where I saw this link, dived into these charts from there. First, I'd like you to take a look at this chart, this table of charts that shows you the return in the US stock market in different periods of time. On the very top, we have each bar representing 1 year. The next one down, every bar represents 5 years, and then the next one down is 10 years, and then the bottom one, every bar represents 20 years. You can see the timetable at the top. This goes from about 1870 through about 2022. What you'll notice is at the very bottom, there are no red bars. Now you'll see that up during the 1 year and the 5 year and even the 10 year, you'll see some red bars. And that shows during those time periods, the total return for the stock market was negative. The stock market was down during that period of time. So the very fact that you see no red bars on the 20-year chart, where every bar represents 20 years, means that in the total US market history, there has never been a 20-year period of time where the stock market was down. So historically speaking, if you buy and hold the US stock market with a minimum time horizon of 20 years, so far, you're guaranteed to not lose money. Now, there are certain 20-year time periods where you wouldn't have made much with a minimum performance of 0.5%. But as far as an asset class goes, that's pretty good. The problem gets in here when you look at these 5-year and 1-year time ranges where there is massive declines in the stock market with minimum performance of down 37%. Because when the stock market is falling that fast, that much during a short period of time, it means people are selling. And the only reason people sell when stocks are falling that far is number one, because they're just scared that it'll fall more, but number two, because they're forced out. Either they need the money to cover losses somewhere else, or they were leveraged and they get forced out by a margin call. Either way, the point is that when stock markets fall that much that fast, many people sell, even though they never would have planned to originally. So going into it with the mindset of holding for 5, 10, 20 years isn't as helpful when you're watching the bottom fall out from underneath the market and you think the world is ending. Might as well get out what scraps I can. And if we take a look at this chart, we can see the best months in US stock market history. Maybe surprising to some, the best month in US stock market history was in August of 1932, just after the big crash in 1929 with a return of 50%. And if we take a look at the worst months, obviously, we're going to be in 1929 with our worst months at 26.5% decline during the month of November in 29. So because of the volatile nature of assets like stocks, there are many financial advisors and many experts and many people who would just say, hey, as long as you buy and hold and don't sell when things are falling, eventually you're going to have a recovery. And if you try and time the market where you try and get out when something is falling, odds are you're going to still be out when you have a big recovery that usually happens pretty soon after the fall. And while that is true, most people are absolutely terrible at timing the market, it really doesn't solve the problem of having to sit through those major losses. Those major losses are what cause the difference between an arithmetic mean and a geometric mean when you look at total returns. And this is that absolutely vital difference that makes and breaks expected performance. The arithmetic mean here is determined by the regular formula for discovering averages that people learn in junior high. You take every single performance, so in this case it would be year 1, you go up 10%, year 2, you go up 8%, year 3, you go down 15%, and so on. You add them all up together and divide them by the total number of periods, so let's say 10, then you get your average here, which in this case would be 8.4%. That's taking every single performance period from 1870 through 2022, adding them up together and then dividing them by the total number of periods. If you do that math, you will see an average return of 8.4%. The problem is that number isn't real. If you invest $10,000 at the beginning and then compound annually by 8.4%, you will be left with a much higher number than the stock market could have actually given you. Meaning when you come up with the average return and you just use the regular average formula, that will get you the arithmetic mean. That will give you an indication that the performance was way better than it actually was. If you want the real performance, you have to calculate to get the geometric mean, which was only 6.9% over the same period. The geometric mean at 6.9% means that if you put $10,000 in and then compound annually at 6.9%, you'll arrive at the number that the S&P 500 could have actually delivered. So what is the difference here between these two numbers and why is it important for you to understand? The difference is that an arithmetic mean takes each individual year's performance and has them isolated as if they have no influence on the other periods of performance. This is not reality in investing. In investing, every year's performance determines how much you start with the next year. Here's an example. If I give you $100 and you go down 10%, where are you? You're at 90 bucks. Now let's say we go up 10%. Where are you? You're not back at 100, you're at 99. So you went down 10% and then up 10. You finished 1% lower than you would have started. And it doesn't matter which order you do this in. If you start at 100 and go up 10%, where are you at? You're at 110. Now go down 10% from there. You have to go down 11 because 10% of 110 is 11. You're at 99. So the order that we have this performance in doesn't matter, but the fact that each period's performance determines what you start off with at the next period is vitally important. Why? Because it means risk management is everything in investing. This is why every single of the most successful traders and investors throughout history always have the same number one rule. They all have very different ways of making money, but all of them have the same number one rule, which is don't lose money. Don't expose yourself to blow up. Never risk a large drawdown on your portfolio. That's the number one rule for everyone. Because it doesn't matter if you expose yourself to massive upside, like being able to go up 50 or 100%, if in 1 year you're also exposed to similar downsides of down 75% or more. Because if you go down by 50% in 1 year and you go from $100 to $50, you need a 100% return just to get back to even. Losses are way more powerful than gains with investing because every period's performance determines how big the percentage is of the next period's performance. So if you have good performance this year and then you have bad performance next year, well, that large percent loss is off of a larger total. And then if you have a bad period where you lose a lot and then you gain some the next year, well, that gain is a percentage of that last year's total amount, which was lower because of the loss. And so it's not about timing the market, it's about eliminating that downside risk. It's about hedging yourself so that you aren't exposed to those 50% drawdowns, those 25% drawdowns, even those 10% drawdowns. So when you see all these big red bars, those are the reasons why the total performance over time is only 6.9%. Because while the stock market has great months and goes up a lot and usually recovers after a decline, you're recovering from a decline. So if the only thing you do in investing is prevent yourself from having large losses, well, you'll still have small losses that will be canceled out by small gains. But then you'll still have some big gains, and those will drive the performance of your account. Now, I go over many different strategies and tactics of how to do this and how to use options specifically and using different asset classes to hedge yourself and make sure you don't have large drawdowns. I use my portfolio allocation mastery class to do that. Get that in the description below. Currently, it's 40% off, that discount link in the description. So if you're interested in that, in more of this, go ahead and sign up for that course and it'll teach you how to do this with your portfolio. But it's essential when investing and when trading, you have that as your number one rule, that you don't expose yourself to large drawdowns, you don't lose large amounts of money, because you will then look at a huge difference between the arithmetic mean and the geometric mean. You'll say, hey, on average, if I look at all my year's performance, I was up, 8% on average, but your real performance wasn't up 8% because you had large drawdowns and all of your large gains each year were just recovering the losses that you had lost from the prior year. It's also important that when you're looking at fund performance data, you look at the fine print and look at to see if they're calculating their past performance with arithmetic mean or geometric mean. Most of the time they will use CAGR for geometric mean. It's called compounded annual growth rate. That's the calculation you want to look for, not average annual performance. That's most of the time going to be arithmetic mean. So over the last 150 years, the stock market has been a decent place to invest, even though there are long periods of time with low performance, negative performance, or over 20 periods of time, even zero performance. But if the only thing you do is hedge yourself and eliminate the possibility of large drawdowns, your personal performance will be way better than the average performance of the average investor. As always, I really appreciate you guys. Thanks for watching. Have a great day.